Welcome to the April 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. So if you find today's discussion valuable, we encourage you to share it with others who might find benefit from staying connected to what's happening in the markets and why it matters. And this month, I want to start off with a reminder that explains a lot of what we just lived through in the first quarter of 2026. Dispersion. This is the next step of the rotation that we have been talking about for a while here on Let's Talk Markets. So simply put, it's the gap between the winners and the losers and how that continues to grow. And how do we know? Because if you only looked at the headline index in Q1, you missed one of the most important parts of the story. Because you saw the S&P 500 fell 4.6% in the first quarter. Its worst quarter since Q3 of 2022. But underneath that headline, the market was far more split than it looked. Take a look at this. In Q1, the dispersion quarter, as you called it, as you can see on this slide, this is the entire S&P 500, okay? So all those little circles are all the companies of the S&P 500. 500 companies, 500 different businesses. Well, let's look on this next slide. The colors make the point immediately. Q1, it really was a mixed bag. Some stocks were hit hard, some were roughly flat, and some had exceptional quarters. So yes, the S&P 500 was down 4.6%, but no, this was not one of those periods where every business in the index traded as if the same thing had happened to all of them, right? You can see there in the middle, the green, those are the companies that did well. And then as it goes to the outside, the red, those that didn't in Q1 of 2026. And here's one more thing that we noticed too. Only around 264 of the 500 names actually finished the quarter in the red. That means the benchmark decline, it was real, but it was not broad-based collapse. It was uneven. It was concentrated sell-off, and a much larger share of the index actually did better than the benchmark itself. Now take a look at this next slide. It exclaims and it talks about why the quarter looked worse than it actually was. Among those 264 losers were some of the heaviest names in the entire index. You've heard of them. We've been talking about them. NVIDIA, Microsoft, Apple, Alphabet. In a cap-weighted market, when the giants stop working, they drag the whole benchmark down with them. And we've been talking about this for some time on Let's Talk Markets, that eventually this would happen. Take a look at the bottom of this table. The hardest hit names were largely software and software adjacent businesses. AppLovin, the worst performer in the index, down 41% in Q1. But that was after it gained 108% in 2025. Software names made up more than half of the bottom 20 performers, with names like Trade Desk, Workday, CoStar, Intuit, EPAM, FICO, and Robinhood, all near the bottom of the leaderboard. Investors spent the quarter repricing high expectation businesses and asking a tougher question about where AI becomes an opportunity and where it becomes a disruption. And then look at this. On the upside, leadership looked like it came from an entirely different market. SanDisk surged 168% in Q1 after returning 559% in 2025, putting it on pace for back-to-back run that almost never happens. The broader memory and optical group followed right behind it. Lumentum up 91%, Ciena up 66%, Western Digital up 57%, and Seagate up 42%, as hyperscaler demand kept the AI infrastructure trade alive. So memory's getting more expensive, guys. Energy and chemical names also flooded the leaderboard as crude spiked during this quarter. In fact, 15 of the top 30 performers came from energy and chemicals. That includes APA, up 74%, Occidental, up 58%, Valero, up 52%, and names like LyondellBasell, Dow, CF Industries, Texas Pacific Land. Leadership in Q1 did not just rotate, it rotated hard into hard assets, inputs, and infrastructure. We talked about this, right? What's the takeaway? Q1 was not just a weak quarter, it was a dispersion quarter. The index looked ugly because leadership changed. And when leadership changes in a cap-weighted market, the headline can look far worse than the average stocks underneath it. And as we keep saying on Let's Talk Markets, that is exactly when disciplined investing matters most. It's actually a perfect lead in here to Ryan's Market Fact because it explains why the quarter felt so exhausting even beyond the dispersion. So you heard me say this. It was the longest correction since 2022. So one of the easiest ways to misread a market is to confuse a long correction with a catastrophic one. And as you can see on this chart, at its March 30th low, the S&P 500 was down 9.8% from its January peak. Not quite the 10% mark, but close. And that made this the biggest correction since the last year's tariff turmoil, and the longest correction, which was 61 days, since the 2022 bear market. Can you believe that? And you can also see the mix of things investors were processing at the same time. It's been a wild quarter, right? War headlines, the crude oil spike, private credit turmoil, and AI disruption fears. What makes that especially interesting is the duration. Since the March 2009 low, the median S&P 500 correction of more than 5% actually lasted 26 days and declined 7.6%. So this year's drawdown was clearly longer than normal, even if it never became a full-blown bear market. Lots of charts today, and this next one adds even more context to this. Through the first 60 trading days of 2026, the S&P 500 was down 7.3%. That ranked as the 12th worst start to a year since 1928. That helps explain why sentiment got shaky so quickly, right? Investors don't just feel pain from how deep a drawdown gets. They feel it from how long it lasts. This market did not break in Q1. It backed up. It dragged on longer than people wanted it to and reminded us that even normal corrections can feel much worse when they last longer than they expected. I'll say it again. That's exactly why discipline matters. Okay, so let's take a look at some of the numbers in Q1 as we typically do. So for the year, S&P 500 as of close of business last week was basically flat for the year, slightly negative. You had the Dow slightly positive, but flat for the most part, and the NASDAQ down about 1.5%. Want to take a guess? The top three equity sectors of 2026 in Q1? Energy, industrials, and materials, the thing we've been talking about for some time to watch out for. Energy up almost 30%, materials up 15%, and you had industrials up almost 11%. What about the bottom three? You probably guessed it. Consumer discretionary, financials, and healthcare. You just take a look at the Fed funds target as well, right around 3.75%. Inflation, 2.6%. Really not as bad as what I think a lot of people feel or what we're actually hearing. But when you see it in the data, 2.6%, still not at the mark that the Fed wants and still higher than the long-term average, but not as bad as what we've seen in previous years. Unemployment, just a little over 4%, and GDP growth in the first quarter, about 0.5%. So hopefully that gives you kind of an idea of what we saw in the first quarter. And really the big point I want to talk about right now is this a repeat of 2025? Well, not necessarily, but the comparison, it can be useful. And take a look at this. As you can see on this chart, the blue line is 2026 year to date through April the 8th, and the red line is 2025. Right now, 2026 looks bruised, but it still does not look as bad as it did last year at this same point. The S&P 500 had already rallied more than 7% from its March 30th low and was down just 0.6% at the end of last week. At the same point in 2025, the market was down 15%. But remember, it went on to finish the year up 17%. Now, that does not mean 2026 will simply copy 2025. I hope it does. But it does mean investors should be very careful about drawing a straight line from a bad first quarter to a bad full year. Bad starts do not automatically become bad finishes. And as this next slide helps explain what powered that rebound that we've seen over the last couple of weeks, the 2.5% gain on April the 8th alone ranked as the 5th biggest up day of the current term so far. And the common thread across the biggest up days has not been politics. It's been relief. In 2025, we saw this. Many of the largest rallies came when markets got some version of trade policy de-escalation. What happened in 2026? Well, the biggest rallies have come when investors got some version of war relief, including the March 31st and April 8th moves tied to hopes for a de-escalation with Iran and lower oil prices. And the point here is not political. The point is mechanical. The market does not need everything to be fixed in order to rally. Remember that. It just needs the odds of the worst case outcome to start falling. Relief rallies can be powerful, but for them to become durable, investors still want to see follow-through from the fundamentals. That's steadier oil, calmer inflation expectations, and earnings that can hold up. And that final chart that you see here, it's a great reminder of why investors have to stay disciplined during stretches like this. I think it's one of my favorites because it just is mind-blowing. A $10,000 investment in the S&P 500 at the end of 1979 grew to $1,926,176 by March 31st, 2026, if you simply stayed invested. But guess what? If you missed the best 5 days during that entire period, it falls to $1,189,703. That's just 5 days. You missed 10 days, $835,000. You missed 30 days, $295,000. If you missed 50 days, that $10,000 investment is only $128,509. And I share this with you because we believe it's important to recognize the behavior of markets. Some of the market's best days show right after the worst ones, which is exactly why overreacting during volatile periods can make the long-term wealth building that much harder. And this is exactly the type of environment where that matters the most, because leadership can change fast and concentrated portfolios can get exposed when the winning areas, when they shift. And that's a perfect lead-in into why we offer our second opinion service. When the market changes and the world gets noisy like it is now, it can be valuable to step back and make sure risk is balanced. The portfolio isn't unintentionally over-concentrated, and every position has a clear purpose. We've seen firsthand how helpful this perspective has been for friends, family, and clients, and we'd be honored to offer that same second look if it would be useful to you. Okay, so I got to close with something fun. And obviously we know the Masters just concluded this past Sunday. One of the most interesting stories out of Augusta actually had nothing to do with who won. The Masters somehow feels classic, understated, and not overly commercial while still being one of the smartest live event brands in sports. It is part golf tournament and part retail masterclass. Okay, so go with me on this. Look at this first master slide. This is the merchandise shop. It's basically its own attraction. People line up for it. They make a beeline for it and treat it like part of the entire experience, because it is. By the end of the week, Augusta is expected to do more than $70 million in merchandise sales. That is a huge reminder that the Masters is not just selling golf, it's selling access to a brand that people want to take home with them. Now, look at the most famous bargain in sports. I really like this one. The $1.50 pimento cheese sandwich. And don't worry if you don't like pimento cheese, the egg salad is also $1.50 as well. You could buy one of everything on the 2026 concessions menu for just $72.75. In a world where fans expect to get gouged at live events, that pricing feels almost unbelievable. And that is exactly why it works. Augusta keeps the most visible part of the experience affordable, which makes the entire event feel even more memorable. And Augusta still knows exactly where the money is. Hats are the best-selling item, with more than 125 styles and roughly one sold every second during the tournament. That's bizarre. So while the sandwiches get the headlines, the merchandise is where Augusta monetizes the emotion of being there. That's smart business. Build goodwill in one place and let memory, identity, and exclusivity drive spending in another. It's genius. And then I got to show this. There's the gnome, which is where this gets all a little ridiculous. The 2026 gnome, if you're there, it only sold on site for $59.50. Okay, not too bad. Now, if you can find listings on eBay, you ready for this? They're around $2,000. I even saw eBay listings north of $20,000 for a full collection of the Masters gnomes. That is insane, but it is also a perfect example of what people will pay for something that feels rare, something that feels exclusive, something that's hard to get. You see this same dynamic across luxury brands, limited edition collectibles, and anything tied to status or nostalgia. Once scarcity becomes part of that story, price starts to matter a lot less. That is what makes the Masters such an interesting business story, not just a golf one. Augusta knows where to be affordable, where to be exclusive, and how to make the whole experience feel special. And from an investing standpoint, that is a useful reminder. Some of the strongest brands are not the ones that try to squeeze every last dollar out of consumers up front. They are the ones that protect the experience, control the access, and let demand build on its own. So I hope you enjoyed that. As I've said before, we're so grateful you joined us today, and we encourage you to share this content with anyone who might find benefit from staying connected to what's happening in the markets, and more importantly, why it matters. We have all these replays of Let's Talk Markets posted on our YouTube channel, and if you haven't checked it out yet, you definitely should. It's home to our Beaver Nuggets and our podcast, Between the Bears and the Bulls. And I'll tell you, we cannot wait to share with you some of our conversations with some incredible guests coming up. So please be on the lookout for our emails announcing the release of our upcoming episodes. A couple of them that are coming up are truly special. Now, and as always, if you have any suggestions or would you like to know what to see from us, just tell us. We want to make sure that the content we're providing y'all and that we're putting out is valuable to you. Okay, all right. So last thing I'll leave you with. I noticed something interesting this year at the Masters. Why is it that all the best golfers bring an extra pair of pants? Well, it's in case they get a hole in one. We'll see you in May for the next edition of Let's Talk Markets. And don't forget, leave it to Beavers.